Buckle up, everybody. We're about to launch into a deep dive, exploring the U.S. stock market and what it might have in store for us in 2025.
Sounds exciting. Where are we headed with this?
Well, we've got some fascinating intel from Pasted Text, a document brimming with predictions and analysis from some pretty sharp market minds.
Ooh, a little crystal ball gazing.
Exactly. We'll be examining the forces that could drive stock prices up, but also shining a light on those sneaky risks that could trip us up along the way. By the end, you'll have a better sense of the landscape, what to watch out for, and maybe even some clues about where to place your bets. Think of it like, like a roller coaster ride through the market. You know, there's the thrill of potential gains, but you also got to brace yourself for those unexpected dips.
I like that analogy. Ups, downs, and a bit of adrenaline along the way.
That's the market for you. But hey, let's start with some good news, shall we? Pasted Text paints a surprisingly optimistic picture for 2025.
Oh, yeah. Tell me more.
They point to some rock-solid economic fundamentals. For instance, S&P 500 earnings are projected to surge over 12% in 2025. That comes on the heels of a pretty robust 9% rise this year. So I'm curious, what does that tell you about the health of those companies, and what does it mean for everyday investors like you and me?
Well, earnings are kind of like a company's report card, right? Strong earnings signal that companies are doing well, raking in profits.
And profits are a good thing, especially if you're an investor.
Exactly, because those higher earnings usually translate into higher stock values, potentially boosting your portfolio's performance. It's like a vote of confidence from the market saying, hey, these companies are doing something right.
And it's not just earnings, is it? The broader U.S. economy is showing some serious resilience. GDP growth is projected around 2.8%, and inflation seems to be stabilizing.
Right.
How does this overall economic picture factor into the stock market puzzle?
It's huge. A healthy, growing economy is like fertile ground for the stock market. When the economy is humming along, people feel more confident. They're more likely to open their wallets, spend money, and that increased spending can fuel even more growth for companies, leading to, you guessed it, even higher earnings. It's a beautiful cycle.
It all sounds pretty rosy so far. But there's another piece of the puzzle that Pasted Text highlights: interest rates.
Ah, yes. The Fed is expected to start cutting rates in 2025.
Right. Now, I know some folks hear interest rates and their eyes glaze over, but this can have a pretty big impact on your investments. Think of interest rates like the price tag on borrowing money. When rates are lower, it's cheaper for businesses to borrow, which means they can potentially invest more, grow faster, and, well, you see where I'm going with this, right?
Absolutely. Lower interest rates can be a catalyst for economic expansion, and that often translates to higher stock valuations. But it's not just about the big picture. Lower rates can also have sector-specific impacts.
Oh, interesting. Tell me more about that.
Well, think about industries that are really sensitive to interest rate fluctuations, like, say, real estate or construction. Lower borrowing costs can be a huge boon for those companies, potentially making them more profitable, and that could make your investments in those sectors more valuable, too.
Got it. So it's like a chain reaction. All these pieces of the economic puzzle are interconnected, and they all influence the stock market in different ways. But, Pasted Text emphasizes that it's not just about the raw numbers. It's also about how the market itself is behaving.
Absolutely. The psychology of the market is a powerful force.
So what are some of the behavioral clues we should be paying attention to?
One really encouraging sign is the breadth of this market rally. It's not just a handful of high-flying stocks driving the gains.
Right.
More than 3/4 of the S&P 500 companies are performing well. This broad participation suggests that the market strength is rooted in a wide range of companies doing well, which could make this bull market more sustainable than those fueled by just a few star performers. Those can fizzle out pretty quickly.
Makes sense. And speaking of stars, we can't forget about the AI factor, right?
Right.
That excitement is still blazing, driving a lot of growth, especially in tech stocks. Do you think this AI-powered momentum has the legs to carry into 2025 and maybe even further?
It's hard to say for certain, but AI is undeniably a major force. It's sparking innovation, attracting tons of investment, and that could continue to propel the market forward. However, there's a little caveat that Pasted Text points out: valuations.
Valuations, huh?
Yeah.
So we're talking about how expensive the market is relative to those company earnings we were discussing earlier, right?
Exactly. Right now, the S&P 500 price-to-earnings ratio is hovering around 28. That's higher than its historical average of 20. So some folks might say the market's a bit pricey at the moment.
So the market's looking good, the economy's humming along, but things might be a bit overheated. Is that what you're saying?
It's a bit of a balancing act. The potential for continued growth is definitely there, but the higher those valuations climb, the less room there might be for error. It's like walking a tightrope. You have to be extra careful not to lose your balance.
Good point. Well, I guess it's time to put on our skeptical hats and take a closer look at those potential risks. What are some of the things that could derail this optimistic outlook, and what should investors be wary of as they navigate this market?
Well, like we just talked about, those high valuations, they could put a cap on the market's upside potential. We also have this cloud of political uncertainty looming with the 2025 presidential election and potential policy shifts under President-elect Trump.
Oh yeah, the political landscape, they can always throw a curveball into the mix.
Definitely.
Some folks argue that, tax cuts could be a boon for businesses and stimulate more economic growth. But on the flip side, trade policies or other regulatory changes could create headwinds for certain industries. How do you see those political variables potentially playing out in the market? And what should investors be keeping a close eye on?
It's a complex scenario for sure. If you're invested in companies that rely heavily on international trade, for example, you'd want to pay attention to potential trade policies like tariffs, which could impact their bottom line. So understanding your portfolio's exposure to those political risks is key.
It's all about being aware of the potential ripple effects, right?
Absolutely.
And even if the economy cools down gradually as expected, pasted text brings up the possibility of those unexpected shocks, those infamous black swan events that could really shake up the market. What kind of events are we talking about here? And how can investors even begin to prepare for the unpredictable?
That's the tough part, isn't it? A global health crisis, a sudden geopolitical shift, a major natural disaster. Any of these unforeseen events could throw a wrench into even the most carefully crafted forecasts. It's about being aware of the inherent uncertainty in the market and building a portfolio that's resilient enough to weather those storms.
So it sounds like 2025 could be a year of exciting possibilities for U.S. stocks, but investors need to be prepared for a potentially bumpier ride.
Yeah, that's a good way to put it.
It's like we're heading into a promising, but maybe a little bit wild landscape. Staying informed, adaptable, and maybe holding on tight to those metaphorical roller coaster handlebars might be a good idea. But now I'm curious. Knowing what we've learned today, would you personally bet on the U.S. stock market in 2025? What factors would weigh most heavily in your decision? It's a question worth pondering as we all plan our investment strategies for the year ahead. Because remember, every deep dive like this is a chance to learn, refine our approach, and hopefully make smarter decisions. So keep exploring, stay curious, and we'll see you on our next adventure.
Sounds good.